G'day guys, welcome back to the Devon Too Good Investing channel. Today in this video we're going to be having another look into Dropbox and why the stock fell so hard after earnings. So in this video I'm going to give 4 main reasons why the stock fell. So if I think back to earnings, I dropped a video with my analysis of Dropbox's earnings, and this was before I even realized the stock fell so hard. And in that video I discussed how impressed I was with the earnings. Quite frankly, they killed it in terms of revenue growth. They killed it in terms of growing their users. They grew their ARPU once again. Their free cash flow was really strong. It's up like 200 million compared to last year. Just everything was really good. The balance sheet was still solid. There was no real reason for me as a long-term investor to be too concerned, but we can see that after the earnings, stock was at 31.47 and it pretty much got as low as, it pretty much fell 11.41% at its lowest. So yeah, in this video, we're going to be discussing why I think that happened after I've had a chance to have a second look. So I believe reason number 1 is this paragraph here. So it says we are raising our non-GAAP operating margin guidance, which was previously in the range of 28.5% to 29% to approximately 29.5%. But that's the good news, right? But here comes sort of what investors didn't like. Taking into the account the aforementioned lease buyout opportunity, we now expect our full year 3 cash flow guidance, which was previously a range of 710 million to 730 million, to be approximately 715 million. This cash outflow is comprised of 32 million for the lease buyout and 16 million for the 2021 installments related to HelloSign. So what I'm reading here is I think investors got surprised by this 32 million lease buyout. Now, to me, honestly, I don't care. If you're a long-term investor in this company, you shouldn't care, because what this does is they're clearing out their leases. The whole company's moving to, working online, and, they're cutting back on their physical real estate. So instead of just holding this real estate and it being useless, they're going to buy out early, save a bunch of money in the long term. However, it's going to cost them 32 million in the short term. And as a result, that's affected what the company believes they'll achieve in terms of free cash flow. They're expecting 715 million, which is still within the guidance that they given. And because they've already hit their long-term margin targets that they were promising by 2024, and we know that revenue growth is still strong, I think the market was actually expecting higher free cash flow than this guidance. So I think, it did surprise the market, but this is nothing to worry about, in my opinion, if you are a long-term investor. Now, the second reason I think Dropbox may have fell is due to their guidance regarding shares outstanding. So we can see that they're guiding shares outstanding to be in the range of 397 million to 402 million shares. And when I look more closely, so if I pop over to their 10Q, their shares outstanding 9 months ended for this quarter that they just released is actually, it's 307.5 million. So this is what their shares are now in their 9 months ended results, 307.5 million. And if we look over here, they're guiding 397 million to 402 million shares. So that means they're expecting the share count in the fourth quarter to increase for some reason, despite them, generating all these cash flows and all that. And I think there's a reason, and this might be, I don't think it's too crazy. And if we look over here, I think Dropbox might be looking to acquire a company, or raise money to reinvest heavily into this. So Dropbox founder Drew Houston, he says we're gearing up for the metaverse. Bring on the metaverse, says Dropbox founder and CEO Drew Houston. We are building towards the metaverse, and I'm really excited about the vision, where Dropbox fits in. If you're working in that kind of environment or in the metaverse, you need that stuff. So for your digital content, Dropbox could help, and that is what we are building towards. It is very early, and it's going to be a long journey. So yeah, it looks like Dropbox will be investing into the metaverse. Maybe they're seeing an opportunity right now, and they want to potentially acquire a company, or raise some money and plow some money, plow that capital into, investing into the metaverse. And this might drive revenue growth and future growth for the company. So I think that's the reason why I think investors got a little scared that the share count is either going to stay flat or increase, despite them promising, buying back shares and all that. But for me, I still think they're going to reach their 2024 free cash flow goal, and I don't expect the share count to really raise that considerably. So I'm not too worried about this. Then the fourth, and this is what I bring up in my last video, but they said that they're on track. They've made a big step forward in free cash flow this year. They've improved it more than 200 million year over year. And they're pretty much saying that they don't expect this to continue to grow at this pace every year. So pretty much I don't think that should surprise anyone. Like, they've already gotten their operating margins to where they expected it to be in 2024. So pretty much the rest of their three cash flow growth is going to have to come from organic revenue growth, which is obviously harder to achieve than just cutting costs, such as what they've done with their shift to online. So I already expected this, so to me this isn't really a reason for the stock to drop, but potentially this might have surprised some investors and caused the shares to fall. And they say that they're equally focused on driving sustainable revenue growth, and who knows, that might be through the their push towards the metaverse. But guys, those are my 4 reasons. Just to recap, the first reason was the lease buyout, which seemed to be unexpected, which resulted in the free cash flow while still being within guidance. Most people probably would have expected this to beat guidance, considering their revenue growth and margin expansion. The second reason was the diluted average shares, staying flat or increasing. And the reason for this, which I speculate, is their interest in the metaverse. I think they're either going to raise some money to invest into this, which in turn will raise the share count, or they're going to be raising money to acquire a company that will help them build into the metaverse. And then the final reason was because of this, the pretty much them telling us that the free cash flow isn't going to extend out. We're not going to have growth this large out into the future. So guys, thank you for watching. Make sure you subscribe, make sure you like this video, and see you in the next one.